I'm going to tell you something that might save your financial life. Charlie Munger died with a fortune worth billions of dollars, but in 1973, he lost half of everything he owned. In 1 year, 50% gone, vanished. Most men would have quit investing forever. Most men would have blamed the market, blamed the government, blamed bad luck. Charlie Munger did something different. He sat down with a yellow legal pad and wrote 13 rules, simple rules he would never break again. Rule that turned a devastating loss into a system that compounded wealth for 50 years straight. Here's what nobody tells you about wealth. The next crisis is already forming. It always is. Right now, somewhere in the global financial system, there's a crack, a bubble inflating, a domino waiting to fall. And when it hit, and it will hit, you'll either have rules written in advance or you'll have regret written in your bank account. Munger said it himself last year. The big money is not in the buying and selling, but in the waiting. But you can only wait if you survive the crash. And you only survive the crash if you write your rules before the storm comes, not during the panic, not after the loss, before. This video is not about getting rich quick. It's not about 10,000x crypto moonshots or overnight success story. This is about not dying poor when everyone around you panic. This is about building a system so robust that you can sleep through market crashes while your neighbor's selling everything at the bottom. Let's begin. Mistake number 1, thinking you can rebuild after you blow up. Charlie Munger's investment partnership dropped 31.9% in 1973. Then, as if the universe wanted to test him further, it dropped another 31.5% in 1974. While the overall stock market was down about 40%, Charlie was down 53%. His investors panicked. Some pulled their money out. Some wrote angry letters. Some probably cursed his name. Charlie didn't panic. He didn't sell. He didn't abandon his strategy. Why? Because years earlier, before he ever lost a dime, he had written his first rule on that yellow legal pad. Never lose permanent capital. Notice the word permanent. This is critical. Markets go down. Portfolio fluctuate. Numbers turn red on your brokerage screen. That's not loss. That's noise. That's the price of admission to the game of compounding wealth. Permanent loss is something entirely different. Permanent loss is when you sell at the bottom because you're terrified. When you leverage yourself into forced liquidation. When you chase a speculative asset with money you can't afford to lose, goes to zero. When you confuse volatility with actual destruction. Munger understood something that most investors never learn. You cannot compound zero. This is not motivational speaking. This is mathematics. If you lose 50% of your capital, you need a 100% gain just to break even, just to get back to where you started. Lose 75%, you need a 300% gain. Lose 90%, you need a 900% gain. At that point, you're not investing anymore. You're praying for a miracle. I've seen this happen hundreds of times in my career. Intelligent people, educated people who read financial books, follow markets, they build a portfolio over 5 years, 10 years, sometimes 20 years. Then a crisis, 2008, 2020, the Silicon Valley Bank collapsed. Doesn't matter which one. And in their panic, they liquidate everything. They sell at the exact worst moment because they can't stomach watching their net worth drop. Then what happened? 6 months later, the market recovered. A year later, it's at new highs. And they're still sitting in cash, traumatized, having locked in permanent loss. They tell themselves they'll wait for the right moment to get back in. That moment never comes. They've lost years of compound, years they will never get back. Here's the test that will reveal whether you have a real portfolio or just a collection of stocks waiting to explode. Can your portfolio survive a 50% drawdown without forcing you to sell? Not, would you be comfortable? That's not the question. The question is, would you be forced to sell to pay bill, to cover margin call, to meet obligation? If the answer is no, if there's any scenario where a market crash would force your hand, you don't have a portfolio. You have a time bomb with a timer you can't see. Rule number 1, structure your entire financial life so you never have to sell at the bottom. That means cash reserve. 6 months minimum. 12 is better. No leverage on necessity. No borrowing against your portfolio to fund your lifestyle. No, I'll figure it out when I get there. Because when the crisis comes, and it will come, it always comes, there is no figuring it out later. There's only the rules you wrote when you were calm, or the panic that destroys everything you built. Charlie Munger survived 13 sessions. He survived the 1973 to 74 crash, the IBE, 1987 Black Monday, the dot-com bubble burst, the 2008 financial crisis, the 2020 pandemic crash. He survived them all without ever being forced to sell at the bottom. Not because he was lucky, not because he was smarter than everyone else, but because he wrote one simple rule and never broke it. Never put yourself in a position where you have to sell when you don't want to. Write that rule down right now. now, before you hear mistake number 2. Mistake number 2, thinking labor can make you wealthy. For decades, Charlie Munger's official salary at Berkshire Hathaway was $100,000 a year. $100,000. That's what he paid himself to help run one of the most successful companies in human history. Meanwhile, his personal net worth grew to over $2 billion. How is that possible? Because Munger understood rule number 2 with absolute clarity. Labor doesn't compound. Equity does. Most people trade time for money. They get a raise from $50,000 to $60,000 and they feel rich. They work overtime, pull extra shifts, take on a second job, and they feel productive. They feel like they're winning. But here's the brutal truth that will offend some of you. At the end of the year, if you stop working, the money stops coming. Immediate, completely. That's not wealth. That's a subscription to your own life. You're renting out your time by the hour. And the moment you stop paying with your hours, the income disappears. Charlie's real compensation wasn't his salary. It was his ownership. He owned a significant portion of Berkshire Hathaway stock. Every year, the company's value grew. And because Charlie owned equity, real equity, not options, not promises, but actual ownership, his wealth grew while he slept, while he sat in a chair reading books, while he took vacation, while he spent hours thinking about nothing in particular. This is the fundamental difference between a worker and an owner. A worker rents out their time. An owner builds equity that pays them forever. The worker's wealth is linear. Every dollar requires an hour. The owner's wealth is exponential. Every dollar can multiply without additional effort. Now, before you misunderstand, I'm not saying quit your job tomorrow. I'm not suggesting everyone should start a business or that employment is somehow shameful. What I'm saying is this: if 100% of your income depends on you showing up to work tomorrow, you're not building wealth. You're building a dependency. You're building a trap that gets tighter every year as your lifestyle inflates to match your income. Rule number 2, allocate at least 20% of your energy toward building equity. Notice I said energy, not just money. This is about focus, about intention, about understanding where real wealth comes from. That equity could take many forms. You could own stocks in great businesses, pieces of companies that grow in value over decades. You could build a business of your own, something that eventually runs without your constant presence. You could create intellectual property, book, courses, software, patents, things that pay you over and over for work you did once. You could invest in real estate that appreciates and generates rental income. The specific vehicle doesn't matter nearly as much as people think. What matters is that the asset works when you don't. What matters is that next year you own more equity than you own today, and the year after that you own even more. That's the only path to real wealth. Everything else is just income. I'll tell you a story that illustrates this perfectly. In the 1990s, I knew two men who worked at the same tech company, both brilliant engineers, both making $120,000 a year, which was good money back then. One man spent his entire salary, nice car, big house, expensive vacation. He told himself he deserved after working hard all. The other man lived on $60,000 and invested the rest in company stock and index fund. Fast forward 25 years. They cheat. First man is still working, still making a good salary, probably $200,000 now, still living paycheck to paycheck, just at a higher level. The second man retired at 55 with $8 million in investable assets. Same job, same starting salary, completely different outcome. What was the difference? The second man understood that labor is how you generate cap, but equity is how you multiply. He used his labor to buy assets that labored for him, and those assets bought more assets. And now his portfolio generates more money every year than he ever made work. One day, through age, through illness, through exhaustion, or just through the desire to do something else with your life, you won't be able to work, or you won't want to. And on that day, you'll either have equity pays you, or you'll have nothing but memories of a good salary. Charlie Munger retired from practicing law in his 40s, not because he was lazy, but because his equity was generating more wealth than his labor ever could. He spent the next 50 years reading, thinking, and compounding. That's the goal. That's the finish line. Not to work forever, to build equity that frees you from having to work at all. Write down rule number 2. Put a number on. What percentage of your income will you convert into equity? Not whatever's left over. An actual percent. 20% is good. 30 is better. 50 if you can stand. Because here's what nobody tells you. The difference between financial independence and lifelong dependency isn't your income. It's your equity. And every year you delay building it is a year of compounding you'll never get back. Now let me tell you about mistake mistake number 3. Mistake number 3. Thinking brilliance beats discipline. In 1998, at the height of the dot-com bubble, a young tech entrepreneur approached Charlie Munger at a Berkshire Hathaway annual meeting. This young man was on fire with confidence. He pitched his idea, a revolutionary internet company that was going to change everything. This could 10x in a year, he said, eyes gleaming with the certainty of someone who'd never experienced a real crash. Charlie looked at him for a long moment. Then he said something the young man clearly wasn't expecting. I don't need to 10x anything. I need to not lose. The entrepreneur walked away confused, probably thought Charlie was too old, too conservative, too stuck in the past to understand the new economy. That company went public in 1999. It 15x in 6 months. The entrepreneur probably felt vindicated, probably thought Charlie was a fool. Then the year 2000 came. The bubble burst. That revolutionary company went to zero by 2001. Bankrupt. Gone. Everyone who bought at the top lost everything. Charlie Munger didn't lose a single dime. Not because he wasn't smart enough to see the opportunity. Not because he was afraid of technology. But because he had rule number 3. And that rule was non-negotiable. Discipline beats brilliance. Let me explain what this really means. Because most people misunderstand it completely. They think wealth comes from finding the next Amazon, the next Bitcoin, the next life-changing opportunity that will make them rich overnight. So they chase, speculate, they gamble on moonshot. When they win, they feel like genius. When they lose, they blame bad luck and start looking for the next moonshot. This is not invest. This is playing the lottery with extra steps. Charlie Munger did the opposite. He had a checklist, a literal written checklist of rules he would not break under any circumstance. And if an investment didn't pass every single item on that checklist, he didn't do it, even if it felt like a winner, even if everyone else was making money, even if he'd be the only person not participating in the rally. This is what separates amateurs from professionals. Amateurs rely on conviction, on gut feeling, on excitement. Professionals rely on system, on checklist, on rules that don't change based on emotion. Think about airline pilots for a moment. Every single time a pilot prepares for takeoff, they run through a pre-flight checklist. Every single time. Even if they've flown that exact aircraft 1,000 times before. Even if they know the plane is fine. Even if they're running late. Why? Because checklists prevent catastrophic error. Because in a moment of stress or distraction, memory fails. Emotion overrides logic, and people die. Your finances need the same rigor, the same systematic approach, the same refusal to skip steps just because you feel like it's fine. Charlie Munger's investment checklist had 13 points. I'm not going to give you all 13. You need to develop your own based on your goal and risk tolerance. But I'll give you 3 that are non-negotiable for any serious investor. First, do I understand this investment well enough to explain it to a child? If you can't explain how a company makes money in simple terms, you don't understand it. And if you don't understand it, you can't evaluate when something is going wrong. This single rule would have saved millions of people from losing money in complex financial products they didn't understand in 2008. Second, can this investment survive the worst-case scenario without destroying? Not will it go up? That's the wrong question. The right question is, if this goes to zero, does my life fundamentally change? If the answer is yes, you're betting too much. Size your positions so that even your biggest loss is survivable. Third, am I buying this because of analysis or because of emotion? Fear of missing out is not a strategy. Envy is not a strategy. Excitement is not a strategy. If you can't point to specific numbers, specific reasons, specific logic for why you're making this investment, you're not investing. You're gambling. Write these rules down. Put them somewhere you'll see them every single day. On your computer, monitor, on your bathroom mirror, in your wallet. It doesn't matter where, as long as you can't avoid seeing them. And here's the critical part. When emotion tries to override logic, when FOMO screams at you to break your rule, when everyone at dinner is bragging about their crypto gain, when you feel like an idiot sitting out the hottest trade of the year, read your rules again. Because I promise you, I absolutely promise you, there will come a moment when breaking your rules feels smart, when following them feels stupid, when you'll tell yourself just this once, or this time is different, or I'll get back to my rule after this one trade. That moment is the test. That moment reveals whether you're a disciplined investor or just another gambler with a brokerage account. Charlie Munger faced that test hundreds of times over 50 years. He passed it every single time, not because he was smarter than everyone else, but because he trusted his rule more than he trusted his emotion. Most people fail this. They make one exception, then another. Then their rules become suggestions. Then they have no rules at all. Then they blow up. Don't be. Rule number 3. Write your investment rule and follow them even when especially when breaking feels smart, because the time you're most tempted to break your rules is exactly the time when following them matters most. Now let me tell you about the fourth mistake, the one that quietly destroys wealth, even when you do everything else right. Mistake 4, quitting before the curve bends. Charlie Munger became a billionaire at age 69, not 25 like a tech founder, not 40 like a Wall Street trader, 69 years old. For 30 years before that, he followed his rule. He invested in great business. He held through crashes. He compounded at roughly 19% per year. 19% sounds good, but it doesn't sound spectacular. It doesn't sound like the kind of return that creates billions of dollars. But here's the thing about compounding that nobody really understands until they experience. It's invisible for decades. Then it's supernatural. Let me show you what I mean with actual number. If you invest $10,000 at 19% per year, after 10 years, you have about $54,000. That's good. That's nice. But it's not life-changing. It's not quit your job money. After 20 years, you have $273,000. Now, we're talking about real money, but it's still not retirement wealth. It's not generational wealth. But after 30 years of that same 19% return, you have $2.4 million. Same rule, same discipline, same boring, consistent process. The only difference is time. The only difference is staying in the game long enough for the exponential curve to bend upward. This is mistake number 4, and it's the one that destroys more potential wealth than any market crash. Quitting before the curve bends. Most people give up in year 5, or year 7, or year 10. They look at their portfolio and think, this isn't working fast enough. I'm only up 50%. I need to be up 500%. So they change strategy. They abandon what was working to chase something that promises faster results. They follow a new guru. They adopt a new system. And in doing so, they reset the clock back to zero. What they don't realize is they were 3 years away from the inflection point. They were 3 years away from the moment when compounding stops being arithmetic and becomes exponential. When growth stops being linear and becomes vertical. Charlie Munger called this sit on your ass, invest, find great business, write your rule, and then do the hardest thing in all of finance. Nothing. Just sit there. Let time do the work. Let compounding run its course without interruption. I know this advice sounds boring. I know it sounds unsatisfying. You want action. You want to feel like you're doing something. You want the excitement of trading, of finding the next big winner, of beating the market by being smarter than everyone else. Here's what I learned watching wealthy for 40 years. The richest investors are the most bored. They make a handful of decisions per year, sometimes per decade. The rest of the time, they do nothing. They read, they think, they wait. While everyone else frantically trading, desperately trying to squeeze out extra returns, they're just sitting. They get richer year after year after year. Not because they're more active, because they're more patient. Rule number 4, commit to 20 years, not 2 years, not 10 years, 20 years minimum. I know that sounds insane in a world of quarterly results and viral overnight success, but here's the reality. If you can't commit to holding an investment for 20 years, you're not really investing, you're speculating. You're gambling on short-term price movement, and that's fine if that's what you want to do, but don't confuse it with building wealth. Compound only works when you let it work. The only way to let it work is to stop interrupting. Every time you sell something to buy something else, you interrupt compound. Every time you trade one strategy for another, you reset the clock. Every time you panic and go to cash, you lose years of exponential growth. Ask yourself this question about every investment you make. Can I hold this for 20 years? Not will I, that's about discipline, but can I? That's about structure. If the answer is no, if there's any reason you might be forced to sell before 2 decades pass, don't buy it. It's not right for you. If the answer is yes, if you can genuinely commit to 2 decades of ownership, then buy it and forget it. Don't check the price every day. Don't panic when it drops 30%. Don't get excited double. Just let it compound. Because the people who get rich in the stock market aren't the smartest traders. They're not the best analysts. They're not the ones with the most sophisticated algorithm. They're the ones who bought good assets and then did nothing 20 or 30, 40 years. They're the ones who were too busy or too lazy or too disciplined to constantly tinker with their portfolio. Charlie Munger bought Costco stock in the 1990s. He still owned it when he died 2023. 30 years. Through the dot-com crash, through 2008, through COVID, he just held it. That single position, that one decision to buy and hold, made him hundreds of millions of dollars. That's not genius. That's not brilliant. That's just refusing to quit before the curve bends. Now, let me tell you about the final mistake, the one Charlie Munger considered the most dangerous of all. Mistake 5, interrupting compounding unnecessarily. Charlie Munger died in November 2023, 1 month before his 100th birthday. In his final years, he gave dozens of interviews and speeches, and in almost every one, he came back to the same theme, the same warning, the same lesson. Learned over 7 decades of investing. He would lean forward, look directly at the audience, and say, "The first rule of compounding is to never interrupt it unnecessarily." Unnecessarily. That word is critical. Most people interrupt compounding every single day without even realizing. They panic when markets drop and sell at the bottom. They get greedy when markets rise and chase the hottest stock. They confuse activity, progress, believing that doing anything is better than doing nothing. And then they wonder why, after 10 years of investing, they're still broke. Why their portfolio barely grew while the market tripled. Why everyone else seems to be getting rich while they're spinning their wheel. The answer is simple. They keep interrupting compounding. Let me give you a concrete example. In 2020, during the COVID crash, the S&P 500 dropped 34% in 5 weeks. Fastest crash in market history. Millions of people sold. They couldn't stand watching their portfolios evaporate. They went to cash, promising themselves they'd buy back in when things stabilized. Things stabilized 5 months later. By then, the market had not only recovered, but hit new high. Those people who sold, they locked in permanent loss. They interrupted compounding at the worst possible moment, and most of them never got back in. They're still sitting in cash today, having missed one of the strongest bull markets in history. Meanwhile, the people who did nothing, who just held through the crash, made money, not because they were brave, not because they were smart, but because they understood that volatility is the price of admission to long-term return. They understood that if you can't stomach 34% drawdown, you don't deserve the gains that follow. Here's what Charlie Munger understood that most people don't. Compounding is fragile. It requires time, patience, and above all, non-interference. Every time you interrupt, every time you sell, switch strategy, or go to cash, you're not just pressing pause. You're going backward. You're destroying years of exponential growth that you can never recover. Think of compounding like a snowball rolling down a mountain. At first, it's tiny, barely growing. You push it yourself, and it doesn't feel like it's doing much. But if you leave it alone, if you just let gravity and momentum work, it gets bigger and bigger. And eventually, it's massive, rolling downhill on its own, accumulating more snow with every rotation. But if you stop it, if you pick it up to examine it, to adjust it, to see if you can make it better, you destroy all that momentum. You have to start over, and you never get back those years of growth. That's what happens every time you interrupt compound. You reset the clock. You start over. And the people who started when you started but never stopped, they're miles ahead now, and you'll never catch up. Rule number 5 is the simplest and the hardest. Don't interrupt compound unless you absolutely must. Notice I said absolutely must. There are legitimate reasons to sell and invest. If the fundamental thesis breaks, if the company you invested in changes its business model, or its management becomes corrupt, or the industry it operates in fundamentally shifts, then yes, sell. If you have a genuine emergency and need the money to survive, medical bills, job loss, true catastrophe, then yes, sell. But selling because you're bored, selling because something else looked more exciting, selling because the market dropped and you're scared, those are not legitimate reasons. Those are emotional reactions, and emotional reactions are the enemy of wealth. Here's a test. Before you sell anything, write down the specific reason. Not, I feel like it's time, or I want to take profit. A specific, logical, unemotional reason. Then wait 48 hours. If the reason still makes sense 2 days later, and it's not based on fear or greed, then maybe it's worth selling. But I promise you, 90% of the time, when you write down the reason, wait 48 hours, you'll realize you were about to interrupt compounding for no good reason. You were about to reset the clock because of emotion, not logic. Charlie Munger went years, sometimes decades, without selling major positions. Not because he was paralyzed by indecision, but because he'd already made the decision when he bought. He'd committed to holding unless something fundamental changed. And when nothing fundamental changed, he did nothing. That's the secret. That's the whole game. Make good decisions, then leave them alone. Most people do the opposite. They make impulsive decisions to buy, then constantly second-guess themselves. They interrupt compounding over and over, believing they're actively managing their portfolio, when really they're just destroying the only thing that could make them rich: time. So here's your final rule, the one that ties everything together. Compound aggressively. Interrupt. Never buy equity. Follow your rule. Commit to decades, and then get out of your own way. Because here's the truth that Charlie Munger spent his entire life proving. Nobody can compound zero. 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 If you blow up your capital, you have nothing to compound. If you interrupt compounding, chase trends, nothing to compound. If you panic and go to cash during crashes, you have nothing to compound. The only way to build real wealth is to get capital. Protect it like your life depends on it. And then let time do what time does best. Multiply it exponentially while you do something else with your life. The final lesson: Charlie Munger spent his last years giving away most of his fortune. He donated to school, to hospital, to causes he believed in. He lived in the same house he'd owned for decades. He drove a normal car. He didn't buy yacht or private islands or any of the stupid things people do when they mistake wealth for status. And he taught one final lesson that I want to leave you today. The goal isn't to die with the most money. The goal is to never worry about money while you're living. That's what financial independence really means. Not private jet, luxury, just the simple freedom to do what you want, when you want, without asking permission from an employer or stressing about bills. And you achieve that freedom not through brilliance, not through luck, not through finding the next Bitcoin. You achieve it through 5 simple rules. 1. Never lose permanent capital. Structure your life so you're never forced to sell at the bottom. 2. Build equity, not just income. Labor gets you started, but equity sets you free. 3. Follow your rules even when emotion screams at you to break. Discipline beats brilliance every single time. 4. Commit to decade, not year. The exponential curve only bends if you stay in the game long enough to see it. 5. Don't interrupt compounding unless you absolutely must. Every interruption costs you years of growth you'll never recover. That's it. 5 rules. Write them down today, not tomorrow, not next, today. Put them somewhere you'll see them every morning. And when the next crisis comes, when your portfolio drops 30% and everyone around you is panicking and selling, and the news is screaming that this time is different, read those rules again. Because the next crisis is not a question of if, it's a question of when. And when it comes, you'll either have rules that you wrote when you were calm, or you'll have regret that you'll live with forever. Charlie Munger survived 13 recessions, 2 depressions, countless crashes, panic, and end-of-the-world moments. Not because he was the smartest man in the room, not because he had insider information, but because he wrote his rules when he was 40 years old, and he followed them until he was 99. Now it's your turn. Write your rule, protect your capital, build your equity, stay disciplined, be patient, and never ever interrupt compounding unless you absolutely must. Do that, and 20 years from now, you'll look back at this moment as the day everything changed. The day you stopped gambling, started investing. The day you stopped following the crowd and started following principle. The day you finally understood what Charlie Munger spent a lifetime teaching. Nobody can compound zero. Write your rule. Survive the crisis. Compound forever. That's the game. That's the only game worth playing. Everything else is just noise.